Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for joining us. Today we're going to look at Netflix. And we're going to look at Netflix through our lens of rational investing, where we focus on five key attributes from a single investment. Number one, we want to see top-line revenue growth. Number two, we want to see earnings growth. Three, strong cash flow, free cash flow. Four is a strong balance sheet, and five would be a well-priced security in the market that we can enter and make sure, and that will give us a good return on investment over the long term. That's what we're focused on here. 5-10-year returns where we can both get return of principal first and foremost, and then return on principal being second. So let's take a look at Netflix. Sorry, can't talk. Let's take a look at Netflix. We're going to do this two ways: free cash flow return and market multiple return. Average the two to come up with our average stock price, and then see what that looks like of an IRR perspective over 10 years. First things first, let's take a look at the 10K. Let's go to the income statement, and we're going to try to derive an EBITDA number and see what revenue is doing. So income statement is on page 41 for the 10K of December 31st, 2019. So moving along, it's cash flow and income statement. Here we go. Fiscal year 2019, 18-17, top line revenue, $20 billion, and that $20 billion grew from the year previously at 15.7 and $11.7 billion. Strong top line revenue growth, excellent. I don't think anybody's surprised by this. Netflix was one of the top performing investments over the last decade. Something like 10,000% return. Absolutely ballistic, fantastic, and that's been driven by top line revenue growth, as you can see here. Operating income here would be our foundation for the EBITDA calculation. $2.6 billion, 1.6, and $800 million. Again, that's growing as well. Excellent, very good to see. Let's come up with our EBITDA calculation. So I'm gonna zip past this and go right to our math exercise where we've taken 10 years of P&L data, compiled it for you to make it a little easier to come up with an EBITDA number, and we're going to look at growth, we're going to look at enterprise value, we're going to look at what it's been trading at to see what the average value for Netflix is based on a market multiple approach. Here in 2019 you can see the revenue that we just discussed, $20 billion, and it's grown from $3.2 billion in 2011, earlier in the decade. That's about a 7x multiple, or 7 times growth over a decade, which is phenomenal. You can see the EBIT, or the operating income in this case, is $22.6 billion. That's the number we saw previously on the P&L. And that also has grown from $370 million to $2.6 billion over the decade. All two very good hallmarks. We go to the cash flow statement, we pull the depreciation, we add depreciation to our operating income, and we get EBITDA. Looking at the EBITDA started at $1.2 billion and has grown to almost $12 billion last year, an average growth rate of 33%. That is very strong EBITDA growth. So I think that's one piece of our equation. The next is the market approach, the market side of the equation. So we've got EBITDA, again, EBITDA being a proxy for cash flow and having strong growth. Let's look at enterprise value. So enterprise value picks up with the debt. We're going to begin looking at current portion of long-term and long-term debt. You can see that that's grown from $400 million to $18 billion last year. That's a significant movement, and that growth rate is much faster than revenue or earnings growth. It's something we want to come back to later on. Excess cash, they had excess cash previously, they now do not. Market cap, that's simply shares outstanding times the share price. Add those up minus the free cash, and I get an enterprise value. And again, the enterprise value is what the business as a whole is worth, adding debt and equity together. If you were to buy it all, lock, stock, and barrel, that's the way we want to look at the business, because it takes everything into position, into account. Whatever leverage that they have applied to the business, we are now capturing that in these numbers. So that's the enterprise value. Enterprise value to EBITDA is taking this number, dividing it by this number, and getting a ratio. That ratio is a market multiple. And oftentimes people will talk about companies trading on a market multiple basis. In this case, the enterprise value to EBITDA multiple. And you can see recently it's been in the low double digits. It's a little surprising. I would think it'd be higher for a company that's growing like this. Earlier in the decade, it was very low single digits. That seems unusually low to me. But on average, 9.5 times is the market multiple. And in terms of a debt, how much debt can they support with that EBITDA? They're currently 1.5 times debt to EBITDA, which is reasonable for a company. Let's move forward now and do a forecast stock price based on this EBITDA. We're going to pick up $11.9 billion of EBITDA, and we're going to use the growth rate that they've experienced historically at 33%, then drag that forward in time. So here you go. Let me get the titles. Here's the next year's EBITDA and a growth rate. I start with 25%, which is less than the average they have been experiencing, and I drag it down as they get larger over time. That average is 19.4%, call it 20%. So you're thinking, on average, they're going to grow EBITDA 20% annually every year for the next 20 years. That's strong growth. Based on what they've done in the past of 33%, it's possible. It might be a little robust, but it's a good number to run with right now. That basically means that they have to produce $70 billion of EBITDA in 10 years from now. That's what we're guessing. Whether that goes up and down, but at the end, you need to hit $70 billion. To get an enterprise value of $837 billion, I'm taking a market multiple of 12 times that future EBITDA number. Again, that 12 times is in line with what they've been trading at recently, in the recent past. Less debt plus cash that they've on average had on hand. Outstanding shares, divide all that, and I get a share price estimate of $457 in 10 years for Netflix based on an enterprise value to EBITDA. Cool. All right, we got one of the two. Let's go for free cash flow, and let's take a look at the cash flow statement, which is my personal favorite. I think I've expressed that multiple times because what we invest here at Rational Investing is cash money. That's what we care about. Not market multiples, not revenue, not EPS, because those can be adjusted, if you will. But cash money you can't fake. It's certainly when it's sitting in someone else's bank account or with in the deposit. That's what we want to see. So let's pick up on the cash flow statement. Here's their net income, $1.8 billion. They run through some adds and subtracts for real cash, and you'll see that they lost money. Cash money they burned operating of $2.88 billion. That's surprising. That's surprising particularly because the operating income was positive, EBITDA was positive, all of those were growing. Why is this negative? I don't know. We'll figure that out. But also take a look, it's not a one-time deal. The last year it was negative, and the year before that it was negative. So there's something going on here. We've got an EBITDA that's positive and growing. We've got revenue positive and growing, but operating cash flow is not positive. And in fact, it's growing at a negative rate. What's going on? So the first thing I want to do is I want to finish the cash flow statement to see if they are losing money, how are they funding that loss? Then we'll come back to discuss this. We check cash flow from investing, which is generally the property, plant, and equipment, buying big machinery, assets, so forth. That's relatively small at $134 million for the that's changed in other assets. To me, $253 million is the number I'm looking for, and that is the purchase of property and equipment. $253 million. That's not much. That's not that bad. Let's go down to the financing activity and see how they're funding both the operating loss, the cash loss, and the capital investment they made. And what you'll see is something very interesting. Proceeds from debt right there. Call that $4.5 billion. Let's look at the previous year, 3.9 and then 3. So this is proceeds from the issuance of debt. So they're funding their operating loss by borrowing money, and they're borrowing increasing dollar amounts of money every year. They're also issuing stock. You'll see that the proceeds from issuance of stock, they're selling their own stock to you and me. They're selling it. They're taking that cash, they're going to the bank and saying, hey, I just raised an equity, $72 million. Give me debt on that. And the bank says, okay, Netflix, I'll give you $4.5 billion with your equity piece of $72 million. That's how they're funding the operating losses. And it's important to realize that. This will carry through in some other slides we're going to look at, but I wanted to point that out. Let's go back now to our cash flow analysis. Here we are. So we did EBITDA market multiple. Now let's value the company on a pure cash money basis. So you'll see, again, 10 years, cash flow from operations. This is the number I showed you before, the loss, and that loss was growing. The loss has been growing for many, many years. In fact, back in the day, they were profitable. They had a strong operating cash flow. OpEx was low. They had no debt. They had strong free cash flow to equity, $3.46 for a yield of 5%. That line there is a fantastic line. But what happens? What happens going forward in time? As they've tried to grow, as they've chased revenue, top-line revenue growth, as shareholders have responded to the top-line revenue growth by higher stock price, Netflix has pushed the envelope more and more and more. And they've done that by increasing operating losses, and they've funded those losses by debt and equity investing. This is just debt, but I showed you earlier some equity that they're selling to go to the bank to borrow that money, and that money is fueling the top line. They're chasing the top line. That's what they're doing. They're disregarding free cash flow, which is what you and I invest in, and they're chasing top line revenue growth, which is what analysts like to hear. It's what TV spokespeople like to say. It's an easy number to understand, and it sounds great. $20 billion of revenue, 7x revenue over a decade. That's fantastic. But what are they making true cash that they can send to you and I as equity holders? Relatively nothing. In fact, these positive numbers are only positive because they borrowed. You can only do that for so long that you run out of credit with the bank. So what was once a strong cash flow yield and a strong free cash flow per share has deteriorated over time to where this number is predominantly funded by debt, and their average growth rate is only 1.3%. Excuse me, the average yield is 1.3%. The average growth rate is actually negative. Now this should be an alarm bow should go off in the back of your head, because remember I said a couple of videos ago that you've got EBITDA growing one way and free cash flow going the other, and generally they should be the same. If not, there's an issue. And that's exactly what we're finding here. The EBITDA is not representative of cash. And remember, when you market multiple approach, market multiple is a lazy way to value a company, because it assumes that EBITDA is a proxy for cash, and in this case, EBITDA is not a proxy for cash. Cash flow is much weaker than EBITDA lets on. So if you value the company based on an EBITDA multiple, you're missing out a big cash cost that's going to cost you in the end. So let's figure out what that cash cost is, and is it rational to keep it or exclude it? To do that, actually before we do that, let's take this and go forward and give a stock price. So let's follow our pattern. We're going to pick up on the free cash flow per equity share of $3. We're going to go forward in time, and we're going to say, because of the negative growth that we're experiencing here, we don't know how to grow this forward. I don't know what to do with these numbers. All right, so I'm going to say that it's going to grow close to inflation over the next decade. I don't know, because it's been decreasing in the past. Is it going to turn around? Is it not? I don't know. We're not speculators. We're investors. I'm going to give it, for the sake of the argument, 3%, and that with a dividend yield of only 1.1%. Remember, I'm dividing a number by a percent. So the smaller this number gets, actually the larger this number gets. right? So that's artificially moving that, because this is so low and I'm dividing this number by such a small number. If this was 5%, let's say, that would be less. So I think there's a little bit of smell check we need to give this number because the yield is so tiny. We would demand a higher yield in cash flow. But for the sake of argument, we're running with it. $4.08 is the cash flow per share target in 10 years at a 1.1% free cash flow yield. That gives me $360 of future stock price, which is slightly less than the $450 we saw with the enterprise value method. So now we have two numbers in mind for a future price. But we have the issue of the cash flows not lining up to EBITDA. Let's figure out why. To do that, we're going to go to our cash flow statement. And in the cash flow statement, you can see it clearly here. There's a giant glaring number that is negative, and that is causing the negative every single year. So it's not a one-time blip. It is an ongoing cost that is not hitting the P&L. Not hitting EBITDA. And it's not hitting EBITDA because we're adding back depreciation into the EBITDA equation, and that is not representing cash flow. So what is this number? What is $13.9 billion last year? It is the additions to streaming content assets. It is what Netflix is using when they produce video content or they go out and buy other video content. So where can we learn more about this? We can learn more about this on page 28 of the 10K. 28 gives a great overview of what is in this number, and let's read it because it's critical that we understand how they treat their streaming service. That'll give us an indication how we can treat the cash flow. So I've got some notes here. I'm going to break these paragraphs down for you. The first paragraph basically says, hey, we capitalize it. It's on the cash flow from operations statement. Second paragraph says we look at it as a non-current asset, and it gives you what's in this number. If you read it right here, for production, we capitalize costs associated with the production, including the development cost, direct costs, and the production overhead. What does that mean? That means salaries for actors and actresses, the director, the renting of sets, the on location, the food carts, the trucks, everything to make the editing, the wardrobe, everything to make the production is outside of the normal operating expenses of the business, and they put it on the balance sheet as an asset. That's going to make it more difficult to link operating results with cash, and that's what you're saying. Let's keep going. So then if you're going to capitalize it as an asset, how long does it stay on an asset? If you're like the Disney company, right? The Disney company expenses all production stuff. Right? What they capitalize, if you remember, they capitalize the investment in ships, the investment in the theme parks, those big assets that last a long time, 10, 20, 25 years. A TV show does not have the useful life. And what they say right here, on average, over 90% of our licensed and produced streaming content assets is expected to be amortized within 4 years. So they're saying right there that we're going to write off the asset within 4 years. I would rather see them expense it all in 1 year. Because these assets are salaries for the people making the content, it's the sets, the food, the designers, the editors, that is their business model. They are in the business of making content or buying content. And if they're going to be in the business of producing content, they should expense it like everybody else. Coca-Cola makes soft drinks. They don't take the salaries of the people making the soft drinks and capitalize it as though it's an asset. No, they expense it. They should be expensing the same thing. And that's what's just driving this difference between EBITDA and cash flow. Let's keep going. A couple more things. Right here, this one I thought was odd and it's particularly troubling for me, and I'd like the accounting firm to push Netflix to update this. It's right here. Our business model is subscription-based as opposed to a model generating revenue at a specific title level. So I take issue with this. Subscription basis is not a business model. You can't go to someone and say, my business model is a subscription. Well, what do you sell? Well, I sell subscriptions. No, you don't. No. Subscription model is a revenue model. It's a revenue recognition model. It's how you monetize your customer. It's not a business model. Your business model, Netflix business model is generating content that I watch. That's the business model. And if these assets that they're producing is the business, it should be expensed when incurred, not capitalized. And if they did that, it would link EBITDA to free cash flow much more clearly. But they don't do it. They don't do it because they know that people look at EBITDA as a market multiple. They don't look at cash flow. Cash flow is more difficult to understand, and it helps protect, it helps shield the income statement, which we're seeing here. So, what are we going to do with this information? So if we have issue with their business model, they should change that and expense it. They're capitalizing costs of people, of manufacturing the product of service. What do? Well, let's change EBITDA so that we no longer add back the depreciation. So what we're going to do, this is 9.3 was the depreciation or the amortization. Now there was a little other stuff in there that was associated with property, plant, and equipment, but it was something like $100,000. No, probably 100 million actually, all the zeros. Yeah, if we call property, plant, and equipment, the depreciation on property, plant, goes 100 million. But this is 9.3 billion. So the vast majority of the depreciation is associated with the cost of making their content. What I'm going to do is I'm going to expense it. That looks like this, right? So I'm not adding it back. I'm saying that it should be expensed. The depreciation is expensed in the operating income. I'm not adding it back, so it's reflecting the operating results. And you can see what that does to EBITDA. EBITDA craters. 2.6 billion of EBITDA. That smell checks much more closely to the 1.3 billion of cash flow. All right, let me just go back and do that one more time. So if I go back and I say, undo what we did, they're saying $12 billion of EBITDA. No. Really, it should be 2.6 billion of EBITDA. That smell checks with the free cash flow a whole lot better. Now let's look at market multiple and the leverage based on a new revised EBITDA that's truer to cash flow. Boom. Your market multiple explodes. You go for something that's reasonably marketed at 12 times roughly EBITDA, to now we're at 60 times enterprise value to EBITDA. That is very high. Also, the debt leverage that they have. They're now at 7 times debt to equity, which is a problem. Anything north of 5 is a red flag for, well, anything north of 3 is a red flag for us, but certainly when you get over 5, it becomes a problem, especially if revenue should take a blip or interest rates change, the market for debt changes, which is what they're living off of. That's a real problem for us, right? We look for solid balance sheet, which is defined partly by low debt. And here, their debt is much higher than we originally thought. So I'm going to reverse, I'm going to add back so I have the original data. And let's go through. So now we've looked at what EBITDA looks like, or the market multiple looks like, if they were to expense the streaming. It lines up with cash, and we see that the valuation there isn't quite what we thought it was. Last thing I want to look at is if the cash flow is negative, right, that we saw, and EBITDA is weak. You got to go to the balance sheet to see how can you support the business. If you're burning cash, you're going to the debt market, you're issuing stock to bring cash in the door to fund these losses. What does the balance sheet look like? Because that's what's going to protect you if things go sideways. So balance sheet is roughly around 42 on the page, 44. Yeah. Let's do this. 44. Can you see that? Yeah. Okay. So let's look at the assets. Total assets, $34 billion. 24.5 billion of that is actually content. It's actually the non-current content assets that we saw earlier. So that's all the previously produced content, the movies that they have purchased or made that they didn't expense, and it's sitting on the balance sheet. Now, if they tried to sell that, if they got in trouble, they'd have to sell it. That's going to be a problem for them to sell. We don't know what's really in that. If I go to page 28, again, where it talks about what is in this bucket, there's a very interesting line here in how they determine that $24 billion. It is right here in the line that talks about therefore here. So if I back up to this line, here you go. Content assets licensed and produced are predominantly monetized as a group and therefore are reviewed at a group level. What does that mean? That means that they're valuing their asset, the TV shows, not on an individual TV show basis. They're not saying, okay, Ozark has a value of $1 billion and House of Cards, well, that's $10 billion. No, they're just taking the portfolio as a whole and saying, yeah, it's about $24 billion. What does that remind you of? Reminds me of the financial crisis, the mortgage-backed securities that they were doing. They were taking individual mortgages, right? They're pooling them together in a group and then selling that group as a mortgage-backed security and saying, hey, it's diversified, you're fine. But the problem was once one went south, it jeopardized the financial integrity of the entire investment. I think the same thing could be here. And that illustration is best represented from the movie The Big Short. If you remember the movie that talked about the financial meltdown, I think this is Ryan Gosling. He's standing here in front of a Jenga tower, and he's saying that each block in the Jenga tower represented a credit class in the mortgage-backed security. And then if one class fell, the whole thing will topple. That's kind of what these assets, these video assets, are on the balance sheet of Netflix. Each line would be a TV show, and if the value of the TV show goes away, like House of Cards, right, had a tremendous value, and then what happened with Kevin Spacey most likely eviscerated that value. If they had that in a couple of TV shows, this whole thing can come down. And if your balance sheet if you're already burning cash and you're borrowing money to fund the losses, the bank's looking at the balance sheet as collateral, well, that collateral could go away like that if the TV shows for somehow would go down in value. And that's a problem for you and me as equity holders because we're last in line for the stack to get any kind of relief. So I think if we were to go back and take a look at Netflix, yes, it has performed extremely well in the last decade. That is the price of the stock. And oftentimes the price and the value, the underlying asset can be different. Right? The price is what you pay, value is what you get. Analogy. So I think here we're seeing a separation between the price as people get caught up on the earnings growth and they're not paying attention to the fundamental cash flow of the business. There's a separation between the price of the stock and the value. Let's go back to our financial model and finish out the review. So if you recall, we had a stock price of $358 and $457 using the two methods. I'm going to average it $407, roughly $400 a share. Well, it's currently trading at $357. I'm saying this is the price a decade from now. That's only a $40, $53, $50, $60 increase over a decade. So if we put that into an IRR perspective, here's the free cash flow they're generating. Again, that's not as strong as we would like to see it. We would like to see 5% yield. This is a 1% yield. So this is already a little weak. It's translating to weaker cash flow. I'm paying a premium today for what is a mediocre long-term return, which is giving me an internal rate of return of only 3%. That's saying if I hold this stock for a decade, my investment here of $357 will yield me 3% every single year. Meanwhile, I'm investing as a common stockholder, meaning I'm all the way back in the capital stack, behind a tremendous amount of debt. Certainly based on a cash flow basis, it is a high amount of debt, and it adds to the risk of being an equity holder. So unless you're going to say that revenue is going to continue to go north at its blistering pace of 30+%, and that investors are continuing to value the company purely off revenue growth, if you believe that, buy it. If you're like this channel and we say no, we have a standard that we use to judge investments, and that standard is underpinned by cash flow, then we're going to have to pass on Netflix. Not saying it's not a good company. I use the service myself. I love the content. But I don't think they're expensing the content properly, and that EBITDA number does not represent cash flow. Cash flow itself is negative, and they're funding the negative cash flow by borrowing more and issuing stock. That's dilution to me as a shareholder and jeopardizes my claim on the asset. Should something happen, I have more debt in front of me when I go to court to argue for my money. So for us, I think there's a safer way to generate return in this financial market, and we're going to pass. I'm going to call Netflix right now an ugly investment. Again, not the stock, not the people, certainly not Reed Hastings, whom I greatly respect. It's just the current market price just doesn't justify the risk of buying the security. Thank you very much for the time. We look at stocks, like I said, on 5 principal investments: top line revenue growth, which Netflix has; earnings growth, which Netflix had. Their EBITDA was growing up. Free cash flow, which is missing, and a strong balance sheet, which is missing, and a stock price that's too high. So that's 3 out of the 5 that didn't meet our criteria. We're going to be passing for now, but I love the story, and I wish them the best of luck. My name is Cameron Stewart from Rational Investing. Thank you very much for watching. I hope you enjoyed the Netflix presentation. It was a lot of fun for me to do. Certainly compare this to the Disney one I did yesterday. Night and day, the two. Thank you very much. If you like these videos, send me comments. Send me stocks you'd like to see. I'm happy to take suggestions. And as always, please subscribe. Thank you very much. Have a great day.